What's up, my didgeridoos? It's No Dumb Question Thursday, and it's not actually Thursday, but we're not going to let that get in our way. We're going to talk about what actually causes the stock market to move, what makes these prices go up or go down. Let's get into it and let's find out.
Tide goes in, tide goes out. You can't explain that.
Now, the first stock ever issued was from the Dutch East India Company in 1602. Stocks are shares of equity in a given company. They're like pieces of a pie, hopefully key lime pie in my case, or maybe lemon meringue, or we get rid of the pies altogether and I'll take some cheesecake. Companies enter the public market to raise money. They let people buy shares in exchange for operating revenue. So a company enters the market with a number of stocks that's equal to the percentage of the organization they're willing to give up control over. When you buy stock in a company, you don't technically own that amount of the company, but you do have control over it, and you're entitled to rights and profits in relation to the amount of stock that you own. So if a company has 100 shares and you own one share out of those 100, then you control 1% of the company. Shareholders can vote in meetings and they receive profit in the form of stock dividends, but sometimes those are also reinvested into the company instead. Most stocks are traded on stock exchanges. There are a number of these, like the New York Stock Exchange, the London Stock Exchange, the Tokyo Stock Exchange, the NASDAQ, etc. A company will do an IPO, or an initial public offering, and then the amount of stock they choose to sell will be available to trade. So then the price goes up and down and all around, and we have Dumb Question Thursday to find out why. Fiscally conscious nerds will say it's all about supply and demand. More analytical leaning and higher tier information sources about the market, like the Motley Fool, will say the stock price changes are driven by information. But what does this mean practically, and how can we be convinced that this isn't really all just about vibes? Well, when you buy a stock, you usually get yourself a brokerage. These days, it's an app on your phone or a website. I had a whole Fidelity desktop application that was really cool, but I couldn't use it because I'd just sit around staring at the glowy numbers moving up and down and just kind of didn't get up for hours at a time. When you set up an account and when you want to start buying stock, you have two options to do it. You can do what's called a market buy, or you can do a limit buy. A market buy is that you're just buying the stock outright for whatever the price currently is, and whatever happens in those milliseconds when you're clicking the buttons and confirming the trade means the price could end up significantly different than you expect. When you make a limit buy, you enter a bid, or the price that you want to pay, and the transaction doesn't go through unless the stock hits that bid price. Same thing when you sell. You can do a market sell or a limit sell. Stock prices rise and fall because people are entering into these two types of trades at the same time. Very basically, when people are buying stock more than selling, then the price of that stock is going to go up. And when people are selling more than buying, then the price will generally go down. Now, when someone does a market buy, then someone who's initiated a limit sell will transfer over their shares. Market buys will trigger limit sells at the highest offer first. So if I'm doing a market buy for a stock that's currently priced at $50, someone who has their limit sell scheduled for $50 is going to send me their share and get my money. And when you buy high, that tells the market that people want the stock and they're willing to pay for it, so the current price is validated and the stock price increases. Where things get complicated, and I will argue this until the day I die, but economics is more about psychology than it is about math. People buy or sell stocks because they hear things about the company that issues the stock. If things are good, then you want to buy in and benefit. If your name is Elon and you designed a sheet metal dumpster that tells you it's a truck and sets fire to itself now and again, then your company's stock is going to go down because people want to sell it. So I don't know. I mean, it kind of is all about vibes. You get a bit of information about a company, as the Motley Fool says, and then you're likely to trade based on that information. Unfortunately, and this is the reason that the Motley Fool's characterization of market forces as information is wrong, is that people aren't rational creatures, and even if you are, you can't count on someone else to be. People are going to react differently to the same information you are. To complicate things even further, there are individual oligarchs and whole organizations that are looking to capitalize on your feelings and make as much money as they possibly can on their own trades. So they're looking to predict what you might be doing, and their actions will heavily influence the market one way or another because they likely own a lot of shares. In fact, the richest 1% of Americans hold half of all stocks, and the richest 10% own around 90% of the entire market. And institutional traders and rich dudes have cutting edge technology that's super expensive and allows them to engage in algorithmic trading. This means computer systems and software that allows for transactions to occur in microseconds, which beats out any hope of you or I ever starring in a reenactment of Glengarry Glen Ross ourselves. This also happens through a process called arbitrage, and this happens when a stock price on one exchange is different than the price on a different exchange. So the price is $100 a share on the New York Stock Exchange, and it's 102 on the Tokyo Stock Exchange. Well, rich people software is going to jump right on that immediately and buy the stock at the lower price on the New York Exchange to sell it for more on the Tokyo Exchange. So another factor that affects the rise and fall of stock prices is rich people games. Most regular people are not doing any of that. Of the tiny percentage of stocks owned by US households, over half of it is tied up in retirement plans. The owners of those retirement account plans are not individually managing those trades. So the bottom line about the bottom line is that the rise and fall of stock prices generally relates to a couple of key things. One is kind of about what someone is willing to pay for something versus what someone else wants to sell it for. Both parties in the transaction have to believe they're getting a good deal, otherwise there wouldn't be a deal at all. Some of it is also about big moves in the market by institutions and individuals who own a large amount of stock. The more you own, the more waves you can make. And another large amount really does come down to vibes. It's just about how you feel about a company or the CEO or the stupid fake truck you just made that looks like it was assembled from the original PlayStation's polygonal graphics engine. Or maybe you think you know something about a company that makes you want to trade a certain way. Fun reminder that if you definitely know something about a company and you trade on that information, that's called insider trading, and it's illegal for everybody except Congress. That's what Martha Stewart went to jail for, and that brings us full circle back to pies, and I'm gonna go have dessert. Please like and subscribe and check out my other videos on big issues and historical disasters, and if you want to inspire the next Dumb Question Thursday, then give me some ideas down in the comments. You can find the sources for this episode along with the links to my website, merch, and Patreon down in the didgeridoo. Let's do some fucking good together wherever we personally can in the world, and I'll see you in the next one.